Welcome, ladies and gentlemen, from me, Guy Monson, Chief Investment Officer of Saracen Partners, to our 9th weekly strategy update. We begin these sessions by looking at the new cases of the virus around the world. And you can see that broadly the infection rates are beginning to roll over, particularly in Europe in the centre of the chart. The UK in dark red at last beginning to tick down, particularly the numbers in London. Italy in dark green and France, again, sharper than expected falls. Note, though, in the bottom of the chart, some reinfection rates emerging in Asia. That light blue line next to the red arrow popping up is South Korea. China, again, some spikes. And on the left, that black line rising quite sharply is the reinfection rates in Singapore. So we must be alert to that. While the news in the West is broadly encouraging, the news in the developed world is still very challenging and has contributed to the 4.4 million total infections that we've seen this week. Brazil, Russia in particular, showing very high new numbers. In a rather harrowing report, the UN emphasised this by saying the pandemic is disproportionately hurting low-skilled, low-wage jobs while leaving higher-skilled workers less affected. This contributes to inequality both within and across countries. There's good news too in the West because the reopening measures continue to be enacted. The IMF have usefully put these into a colour-coded grid, a green open with restrictions, yellow partially open, red closed. Now you can see in the bottom three boxes the figures for Asia, a lot of green, not yet events, a large gathering and travel. But also as you move right to those ticks, you can see they've all got strong contact tracing, strong social distancing, targeted isolation, and testing expansion. That grid of ticks is not so well worked out in Europe. In particular, the contact tracing is not mandatory as it is in much of Asia. Now, yes, the opening schedules are behind Asia, but you can see the possible risks of reinfection. The markets were relatively weak last week, despite the quite good news on reopening. And I think this was in no small part to a very sobering, but also very realistic speech from Jerome Powell, the chairman of the Federal Reserve. He just reminded us that deep recessions leave deep scars. You can see on the right what happened after 2008-9. The red line is the pre-crisis trajectory of growth. The light blue line shows the dip as we lost capacity in the crisis, but also the new trend line was less pro-growth. And why does this happen? It happens because household and business insolvencies can weigh on growth for years. Long stretches of unemployment damage the workforce, professional networks dry up, and thousands of small and medium-sized businesses get challenged or even disappear, and they are the engine of job creation. Now, Powell's quite sobering remarks were in quite sharp contrast to Andrew Bailey of the UK Central Bank, the Bank of England, who is still seeing a very V-shaped recovery. We're hearing talk more of a swish, if you can think of the Nike logo, down and then up, but at a much slower rate. You can see the damage that's being caused every day in the immediate numbers, the US unemployment rate we looked at last week at 14.7%. Add on the right the pre-claim numbers, which although they're falling, were still 3 million last week. We have a potential unemployed pool in the US of 38 million workers, or 23% of the workforce. In the UK, some of the high-frequency data is extremely challenging. Car sales down 97%, the lowest number sold since 1946, and the lowest ever reading the UK Construction Survey. You can see the pressure on the government to get people back to work in some of these factories and construction sites. Nevertheless, overall, our two key indicators we're looking at Saracen, long-term US inflation expectations and the Italian-German bond spread, show that in the case of the former, we're not slipping into alarming depression. The number is low at 1.43, but it is not at a crisis level. On the right-hand side, the Italian-German bond spread, which gives you an indication of how stable the Eurozone is, has actually narrowed, despite that very aggressive ruling from the German Constitutional Court in Karlsruhe that questions the whole QE process. So what does this mean for financial markets? Well, I indicated they were challenging over the week. For the month, though, we're still up modestly and up substantially from the March 23rd lows of world markets. Despite being the obvious laggard in yellow, UK equities did a little bit better. That's on a much stronger oil price, albeit from very low levels, after those extraordinary negative prices we saw a week or two ago. Saudi and Russia cutting back on production even more aggressively than I think markets had hoped. On the other side, at the top of the chart, gold made a new high for the year to date, as central bank reserves on the right-hand side flow into markets as these QE and financial support programs continue to expand around the world. Even the Bank of England talking about increasing the size of their program and supporting asset prices, and in particular, safe haven inflationary assets like gold. The gilt market was modestly up on the week, but the Treasury market now is actually flat on the month. That, to an extent, is encouraging because that uncontrolled rush to lower bond yields is beginning to abate, and that's good for growth expectations. So where does that leave us? Well, we continue to believe the economic risks are severe, but the policy response from central bankers is extraordinary. This leaves us neutral in bonds. We've added recently to investment grade credit, still very cautious on high yield and EM debt. In equities, we're neutral to developed markets, but I'm afraid still underweight emerging markets, with most of our holdings concentrated in China. In alternatives, we're holding our large gold positions and also our infrastructure and alternative energy holdings, which have been remarkably stable against this backdrop. Cash is neutral, and the key risks to us, first of all, the Brexit deal continues to be a high-wire act, and I'll be reporting on that next week. That's keeping our sterling weighting low, and we're watching closely for second-round infections to hope that Asia experience this week is not repeated. Thank you.